I've got answers to the 5 most common questions about the mandatory Roth 401k catch-up contribution start next year. Got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, thanks to the Secure Act 2.0, lots of tax changes, lots of flexibility, lots of Rothification. You need planning, working with a certified financial planner, looking at these new tax rules and how it makes sense and how they fit within your entire financial plan, your entire financial life. And of all of those changes, there was really one, maybe a little bit more than that, but primarily one that was more restrictive as opposed to flexible. And that is a rule that starts next year. It was going to start in 24. They pushed it to 2026. And that is certain individuals are forced to have their catch-up contribution go into the Roth side of their 401k. So, you know, if you're younger than age 50, then you can contribute up to 100% of your income into your 401k up until the limit of $23,500. So if you only make 20 grand, you can put all of it in there if you want. But if it's your career and you're making 60 grand, you're making 100 grand, you're making 200 grand, whatever, you can contribute up to that maximum 23,500. As soon as you turn age 50, or the year you turn age 50, you can then do that, but you can also do a catch-up contribution. You can do a little bit more in this final stage as you're preparing for retirement. $7,500 is that catch-up contribution starting at age 50, and as we know, this year, right now, 2025, there's now a super catch-up contribution in the years you turn age 60, 61, 62, and 63. You can now do $11,250 during those years instead of $7,500. But starting next year, if you're considered a high income individual, and they're calling that you make more than $145,000, then starting in 2026, your catch-up contribution, not your normal 401k contribution, but your catch-up contribution has to go into the Roth side of your 401k. It has to. There's no choice. It's mandatory. Okay, tons of questions on this, guys, by the way. There's lots of moving pieces, but the 5 most common questions, I'm going to hit them right here. First question, and this was my question when I heard about this rule: what year's income counts, right? Is it if I'm going to earn $145,000 in 2026, but I don't know that until the end of the year, how will I know if I can make contributions to the pre-tax side for my catch-up contribution or not? So which year's income counts? It's from the prior year. So 2025's income is the income that counts to determine whether you can contribute. You have to do Roth for your catch-up or not in 2026. So it's the prior year, not the current year, and that's going to be very confusing, but that's question number 1. Question number 2, what income are we talking about? There's tons of different income. There's adjusted gross income, there's gross income, there's taxable income. What if your wages are $130,000 and yet you've got interest and dividends and capital gains and so on of another $20,000? Are you, because now your income's over $150,000, are you part of this group, highly compensated, and therefore your catch-up contributions are required to go Roth starting next year? No, it's just your wages. If your wages are $130,000 or are below that $145,000 limit, but your overall adjusted gross income or all of your other income sources add up and they're more than $145,000, doesn't matter. If your wages are less than $145,000, then you still have the choice of your catch-up contribution for that next year being pre-tax or Roth, up to you. You're not required to do Roth. Third question, what if I switch employers? What if I switch jobs? How will my new company know what I earned at my old company last year? Doesn't matter. Doesn't matter. You're going to get this question all the time. Again, these are most common. It's looking at the 401k that you're contributing to from that what's called plan sponsor, or from that employer. What were your wages from that employer last year? And if you switch jobs, then that employer, your wages with them last year were less, right? It's looking at that employer. So pretend this year, 2025, You work for the same company all the way up until September, but then in September you switch to a new employer, and you made $200,000 in your first employer until September. You switch jobs and you're working with the new company. You only make 50 grand. Okay. Together, you made more than 145. You made $250,000. But with the new company, you only made 50 grand in 2025, and therefore in 2026, your Roth contributions can be pre-tax, or excuse me, your 401k contributions can be pre-tax or your Roth. It doesn't matter for your catch-up. What if I have multiple employers? Again, you're looking at the plan sponsor, the employer that is sponsoring the 401k. You're looking at wages only from them, not from other employers or any other income. And then the fifth most common question, what if my 401k company does not offer a Roth feature, a Roth side to my 401k? What do I do then? Now, even though this is a common question, I do think it's going to be rare. Right now, and I don't know the exact percentages, somewhere north of 90% of 401ks offer the Roth side. And because of this new rule and what I'm about to share with you, many more are going to be adding it. I think we'll be close to 100% by the end of the year. But what do? Well, if you earn more than $145,000, and therefore you wouldn't be eligible to contribute pre-tax, but your company doesn't offer the Roth side of the 401k, you can't do catch-up contributions. If you earn below that, you can do a catch-up contribution. But if you earn more than that 145 and there's no Roth side to your 401k, you can't do a catch-up contribution. You're just excluded from it. So lots more questions, a lot more planning issues with this mandatory Roth catch-up contribution starting in 2026. So there'll be a lot more content, lots of planning issues that we'll work through together. But those are your top 5. Make sure you're working with your CFP on that. If you're going to make more than $145,000 this year and you're going to be impacted next year, you need to start planning ahead for this. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well. Or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.